Hello, I'm Stephen Lindwell. Welcome to episode 4 in this series on the infinite banking concept. Just a quick disclaimer here. This presentation is for educational purposes only, and there's lots of qualified and licensed professionals out there that can speak to your specific circumstances. So, engineering for efficiency. Policy design determines whether you bought insurance or built a banking system. Nelson Nash often said you finance everything you buy. So far in the series, we've talked about the banking function in your life. You're already making the banking business. You move money, you finance purchases, you manage capital flow. But here's the next level question. If you're going to build your own banking system, how efficiently is it engineered? Because even banks don't just have money. They design capital structures carefully. Ratios matter, capitalization matters, efficiency matters. And at the same time, the same is true for your personal banking system. Today, we're going to look at how policy design determines whether your system hums like a well-built engine or just idles quietly in the driveway. A properly structured infinite banking policy is built from 3 components: the base premium, paid up additions, often called PUAs, and dividends. And yes, the death benefit is central to all of this, because the death benefit drives the long-term cash value. It's the structural anchor of the entire system. Now, here's what most people don't realize. The mix or the ratio between that base premium and the PUA dramatically affects a lot of things: the liquidity, the capital efficiency, the speed of usable growth. 2 policies can come from the same company, have the same name, same brochure, completely different performance. Structure matters. You wouldn't build a Ferrari engine into that school bus chassis now, would you? And you wouldn't want your banking system engineered accidentally. Design determines outcome, and policy design can vary significantly depending on the insurer and the advisor securing or structuring the contract. So let's focus in on the paid up additions. Some insurers refer to them as EDOs, accelerator deposit options, just in case you hear that term. So PUA or EDO allows you to inject additional capital into the policy beyond the base premium. This increases the early cash value, it improves the liquidity, accelerates the capitalization. Think of PUA as the turbocharger in the banking system. Without it, you're idling in the driveway. The car technically works and eventually gets there, but it's not inspiring. With properly structured PUA, you're moving efficiently, you're building usable capital much earlier, you're getting there before you've even finished your coffee. The destination might be the same long term, but the velocity and the flexibility are very different. And in capital strategy, velocity matters. Now, here's where the engineering becomes a little philosophical. The ratio between the base premium and the PUA changes everything. A high base, low PUA structure, slow early cash flow growth, higher commissions, less early liquidity. And then contrast that with a higher PUA, lower base structure, gives you greater early usable capital, improved efficiency, and stronger long-term flexibility. Now, commissions aren't evil. They just influence design decisions. One funds the agent's vacation, and the other funds yours. So this isn't about criticism, it's about alignment. If your goal is long-term capital efficiency, the design must reflect that priority. Because incentives shape structure, and structure shapes outcomes. So again, ask yourself, is your financial system working for you, or are you working for it? Now let's zoom out. Wealth is rarely built by chasing the highest return. It's built by reducing drag, lower friction, lower unnecessary cost, greater structural efficiency. It's like trying to win a race. You can buy a faster car, or you can just stop driving around with your parking brake on. Most people never realize they've been racing with the brake half on for decades. Inefficiency compounds quietly. So does efficiency. So the question isn't how do I go faster? It's where's the drag in my system? Because when you remove drag from your banking system, momentum builds naturally. So let me leave you with two questions. Number one, is your current financial structure engineered for efficiency or convenience? And number two, if you remove the parking brake from your system, how different would your long-term trajectory look? Just reflect on that. So in closing, efficiency matters, ratios matter, incentives matter. If you're going to build a personal banking system, it should be designed intentionally. Policy design determines whether you're building a small savings account or a launchpad for future capital. Today, we're building that launchpad. Design determines the outcome. And when a policy is designed properly, it becomes a tool that helps you control the banking function in your life. In the next episode, we'll explore how this structure creates one of the most powerful advantages in Canada, tax efficiency, and how to keep taxes away from your wealth. I'll see you there. Thank you.